Right. All right. So we ready to get into chapter 2 of the life licensing class, and this is going to be on types of policies. Part 2 is on types of policies, so we're going to get into that to make sure that we understand the difference between the two types of foundational policies. What we have what's called term, and then we have what's called cash value, and so we're going to talk about the differences between those two uh, in this chapter. So chapter 2, types of policies, and we're ready to roll. First off, any questions on anything that we covered on chapter 1? Anybody got any questions on anything we covered on chapter 1? All right, good. So when you're doing a lot of your practice tests, because you all got the app on your phone, you download the primary app, or if not, I'll show you how to do it, but you're gonna be able to take practice tests. And really, that's really how I passed my test. I didn't really go to no class. I got online and I did practice tests on each chapter, and I kept staying on the same chapter until I scored an 80.
Okay.
When I scored 80, it let me know that my understanding was fruitful. Then I went to the next chapter, and I got 80 on that. And the sixth chapter, I just went to 80, 80, 80, 80, 80, 80, and then I took the whole thing online practice test, and I knew I was ready. So if I master each chapter, don't try to bite the whole elephant. Like when you go online, we're covering 2 chapters. Do your practice test 3 times on chapter 1. By the time you get to your third one, you're gonna be at about 80%. Because every time you get a question wrong, it's only 15 questions. Every time they cycle it around, it's gonna be 15 questions at a time.
Come back around.
Yep, it's gonna come back to 15 questions and just say, okay, you got this wrong, here's why you're wrong. Right? And if you don't really understand, I have to tell you why you got it wrong. You're gonna hit review content, and the computer gonna pull up the part in the book where it explained it in details. So you're gonna be teaching yourself. So you gotta put in every night by 9 o'clock, you're gonna get a call from your upline, your trainers. And they're gonna ask you, what did you score today on your practice test? So every night, you need to study your practice test, your chapters. Chapter 1 tonight, chapter 2 tonight, because that's what we're covering. Right? And then I'm gonna give you some homework assignments on what you need to go through on Wednesday. We ain't got no classroom on Wednesday, but Wednesday I'm gonna give you some stuff that you need to cover that we're gonna glance over, but you gotta put your time in Wednesday to study on your own. Then Thursday, we're gonna hit the 2 main chapters that's gonna be on the test. We're gonna go 1 and 2 today. Y'all going home tomorrow and go over 3 and 4. We come back Thursday, I'm covering 5 and 6. So then now we got everything covered. And y'all should be about ready to test. But the key is that tonight when you go home, you go in and you do practice tests 3 times on chapter 1. By then you should get close to an 80 or above. Then after that, you do chapter 2 3 times. It's 15 questions. That's it. It's only 15 questions. You'll get 80 or above. So that tomorrow, all you're doing is reading in this book on chapter 3 and 4.
Okay.
Right? And then and that night you're gonna take practice tests on what? Chapters 3 and 4. Thursday, when you get here with me, we're gonna do chapters 5 and 6. Thursday night when you go home, you're gonna be doing practice tests on chapters 5 and 6. So Friday, you'll be taking the whole exam on practice online, so you can get the green light, then let you know you're ready. You should be tested by Saturday no later than Monday. Does that make sense? We ready to rock and roll? Because this, even you're hearing it for the first time, so it seems a little bit much.
Right.
But after you going through it, all this stuff ties in. You know how we was going down in the book and I was able to bring up something that we already talked about? The whole book like that. It's all tying back together.
Okay.
So by the time y'all start getting in y'all practice test tonight, it's gonna start making more sense. So let's go into chapter 2. And chapter 2 is going over types of policies, whole life term, universal, and all that. So I'm gonna make this stuff just in the simplest forms for you guys.
Page 25.
Is it page 25? All right. So page 25. So Justin, why don't you start off reading for me on page 26, where it says term life insurance.
Term life insurance is a temporary protection because it only provides coverage for a specific period of time. It also known as pure life insurance. Term policies provide for the greatest amount of coverage for the lowest premium.
I like that. It's pure life insurance and it provides for the greatest amount of coverage for the less premium. That's term insurance. You get more coverage for a lesser dollar amount. That is term. It's for a specific period of time. It's not forever. Keep going.
As compared to any other form of protection, there is usually a maximum age above which coverage will not be offered or at which coverage cannot be renewed.
Right, so they got a cutoff. So our maximum age that we will offer to you if you're not already a client is age what?
95.
No, we'll insure you to age 95, but we're not gonna offer you a policy if you don't have one already at
Okay.
age 70. So we're not gonna offer you a new policy past age 70. If we're gonna offer you one past age 70, what type of policy we gonna offer you? Adverse selection. Does that make sense? So ours is, this not on the test, it's just for you to know your knowledge of your product. This ain't no state guideline. Our company, we would insure somebody up to age 70 for a 95. Adverse selection will take you to age 100. All right? All right, so we good. All right, so jump down to where it says level term.
Level term.
Because there's 3 types of term policies, guys. Right? Well, not just 3, it's about 5 of them, but you got level term. You got, the level means that what? What when you hear the word level, it means what?
Even.
Even, stays the same.
Right.
You got increase in term, you got decrease in term, you got annual renewable term, right? And you got term with return of premium. So they all are temporary policies, but they got different how you say the word, functionality. Yeah, different functionality. So go with level term, Justin.
Level term is the most common type of temporary protection purchase. The word level refers to the death benefit that does not change throughout the life of the policy.
Highlight that. The death benefit doesn't change throughout the life of the policy. It stays level. So if you got 100,000, you keep 100,000 unless you change it. But the insurance company ain't gonna come back and change because they bound forever. Right? Now, if you want to drop it down some or take it up some, it's up to you. Go up to the top. Keep going.
Level premium term, as the name implies, provides a level death benefit and a level premium. During the policy term,
Don't worry about the example. I just gave it to you. So if you took out a 20-year term and it's $50 a month, it's gonna be $50 for that whole 20 years. It will not change. It remains what? Level. So what stays level? The premium. What else stays level? The face amount. Premium stays level for that term that you're in, 20, 30 years, whichever one you took it out for, but the death benefit stays level forever. Unless you change it. Go to annual renewable.
annual renewable term is the purest form of term insurance. The death benefit remains level, and the policy may be guaranteed to be renewable each year without proof of insurability.
So you ain't gotta prove that you're healthy. So even though on any renewable term, it's saying that you gotta renew this policy every year. So every year you're older. So you all see where the stairs or the premium, every year you renew it, you took it out at 20, now you're 21, cost you more. Now you're 22, cost you more. Now you're 23, cost you more. So you take out an annual renewable versus level, every year they come to see you and get you more, get money from you. But all things equal, if you take out a $100,000 20-year level term, that's gonna cost you more than a $100,000 annual renewable term. Annual renewable term may cost you $7. A 20-year level term may cost you $30. Because the annual renewable, they can come see you every year. Does that make sense? And get more money out of you, and they only committed to you for 1 year. You ain't got to prove you healthy. You just got to pay the increase in price. And at some point, the annual renewable term is going to cost you more per month than the level one, because the level would have locked you in right at that point, at that age, for that many period of time. Annual renewable term don't. So when somebody's ready to go to Iraq or something like that, they may buy an annual renewable term because they can go get $1 million for $30. They come back home, maybe they don't renew it, but they can if they wanted to. Does that make sense?
Okay, so you renew it every year?
Every year, and it's gonna cost you more on annual renewable. So I would never buy annual renewable policy unless it's like I'm gonna go to Iraq or Africa and I might not make it back. So I got my level term for, a couple million. I'm gonna take out another 5 million in annual renewable.
Okay.
And I hope I don't have to renew it. And I hope she don't get paid out on it. I hope I make it back. But if I don't, I wanna make sure that everybody good.
Right.
All right, go ahead, Justin. Go down to decrease in term.
Decrease in term policy feature a level premium and a death benefit that decreases each year over the direction of the policy term.
All right, so highlight that. Every single year, the face amount is gonna decrease over the duration of that term. Your face amount is gonna go down every single year. All right, so you take out a policy, and this is for people who got like mortgages. If I die, I want my house paid off, or you owe a debt to somebody, right? I loaned you $10,000, then I can take out a $10,000 life insurance policy on you. But remember, I gotta have an insurable interest. What's my interest? You owe me 10 grand, right? So at some point, you've been making monthly payments. Will you always owe me 10 grand, or is that balance gonna go down?
It should go down.
It's gonna go down. So as it goes down, so does the face amount goes down, because I can't insure you for more than what you owe me. Because if you only owe me 10 grand, but I got you insured for 20, I have an incentive to do what? Kill you. I'm gonna make money off.
I'm gonna make money.
But if I only loaned you 10 grand, I can only insure you for 10. When that 10 drops down to 8, I can only insure you for 8. When 8 drops down to 5, I can only insure you for 5, because I gotta be interested in your longevity. I can't keep a 10 grand policy on you, but all I owe you is 5. Or all you owe me is 5. So you buy a decrease in term. That's more so to cover debts.
Okay.
Premium stays the same though. Even though you're losing debt benefits, It's decreasing, premium stays the same, premium is level, face amount goes down. So whenever you hear a decreasing term, what decreases? The face amount, the death benefit, the premium stays level. So every time you're dealing with that decreasing or increasing term, the face amount is what increases or decreases. The premium stays
The same.
the same, unless it's annual renewable.
Okay.
Make sense?
So, do you agree to that what do you do after you pay it all off? You're not covered anymore, huh?
No, because you only bought it for the specific point of, if I die, I want my house paid off.
Okay.
So I owe my house for 30 years.
Oh, so it's, okay, got it.
Or
So
I
it's a
own this
30-year,
30-year term, and it goes down with the,
okay,
because all you gonna owe the mortgage company is
right.
100 grand.
Right.
Now you only owe them 50. Now you only owe them 40. Now you only owe them 10.
Yeah. So what do you get out of that? Nothing, really.
You transfer, yeah, if you die, you transfer the risk. If I die, my house will get paid off.
Right, okay.
If I crash, my car gonna get paid for. If I die, my wife keep my income. All insurance is the transferring of your risk. Right now, you risk if you die, your house may not get paid off. You transfer that risk. Here, Mr. Insurance Company, here's $50 a month. You mean it's decreasing term policy?
And in return, your wife has a house that's paid
So it's
for,
gonna be paid
Exactly.
for.
and she no longer has to worry about
Right.
that.
guess it
Now,
makes-
philosophy-wise, I wouldn't buy a decreasing term. I'm gonna buy a level term
Right.
because the premium gonna stay the same anyway. So if I'm gonna pay the same thing, I just wouldn't make my debt benefit go to the mortgage company. I wanna get it, so I can choose if I wanna keep the house or not.
Right.
So if I bought a $50,000, a $500,000 worth of life insurance to pay out my mortgage if I die, I'm gonna get that level. And even though I may only owe the bank $250,000, if I die, my wife get to choose. Well, I take $250,000, pay out the bank, and I keep the other $250,000.
Right.
Or sell the house. It's up to her, 'cause she may not wanna be in the house with my memory. So whatever, you got options. So philosophy, I understand, but would I personally buy a decreasing term? No, because you're not gonna charge me the same price and give me less of a benefit.
Right.
I ain't signed up for that.
Right,
Make sense?
exactly.
All right, keep going. Go to return of premium. I'm sorry, increase in term.
Increase in term features level premiums and death benefit that increases each year over the duration of the policy term. The amount of increase in the death benefit is usually expressed as a specific amount or a percentage of the original amount. Increase in term is often used by insurance companies to fund certain riders that provide a refund of premiums or a gradual increase in total coverage, such as the cost of living or return of premium
So
riders.
all he's saying is that the cost of living goes up. So if you wanted to say, if I die, I want to leave my family $1 million. Well, $1 million today will buy a certain amount of stuff. $1 million in 30 years ain't gonna buy that same stuff. So you buy an increase in term because you want to offset inflation. Or they'll use an increase in term to give you what's called a return of premium term, which simply means that we're gonna give you a return of your premium. So whatever you paid into it, right, after 10 years, we'll give you back all your premium. But they really don't, because they charging you for that rider. You're gonna pay for a rider to get all your money back. So you don't get all your money back, you get the money back outside of the rider that you paid for to get your money back. And if you so the policy gonna cost you way more money than getting a regular term, just so you can get all your money back. Well, you
They
loaned
gotta
them,
make money.
yeah, they gotta give you money, so you loaned them your money with no interest, so it's better to just take whatever you're gonna pay for that return of premium, forget the return of premium, take that money, put it into a mutual fund, go get you 12% return. You're gonna be better off. So return of premium term is something that some companies do to try to offset our buy term invest different philosophy. Does that make sense? All right, so let's return of premium. Okay, give me your name again.
Dawn.
Dawn, all right, pick up with traditional whole life on page 29. So we covered term. Ain't nothing else to talk about with term. Term got pure debt protection. When you die, you get the debt protection, right? Unless you got a return of premium, then they give you your premium back. But you got an increase in term, which means what increases? What increases on the increase in term?
Ain't it the
premium?
No, the premium
face-
always stay the
face
same. The
amount.
face amount is to offset inflation. Remember, cost of living gonna go up. Decrease in term. What decreases?
The,
Face amount.
Face
Always remember, on term, the premium
The
stays.
face amount is basically the payout, right?
Yes, exactly. The premium stays the same. So whenever you're in term, level term is for 10, 20, 30 years. The premium stays the same and the
Face
debt
amount.
benefit stays the same. Increase in term, the premium stays the same, the debt benefit increases. Decrease in term,
It decreases the face.
but the premium
Is the same.
stays the same. And your renewable, the premium increases
And
every year,
Year.
but the
Every
face
year.
amount stays
the same.
Same.
the same. Does that make sense?
And we're gonna
Face amount stays the
agree
same.
on that.
It's annual renewable. Just think about it. I gotta renew it, so I'm a year older. Annually, the insurance is based on your age, your health, and your habits. So a year later, I'm a year older. But I ain't gotta ask no medical questions. It's guaranteed renewable, but I gotta pay the up charge. Decrease in term, what decreases? The face amount. Increase in term, what increases? Face amount. Level term, it stays the same. Always remember, in term, the premium stays the same for the term. And in renewable term, the premium stays the same for the term, but the term is just annual.
So question, I guess they get to choose, I guess, which type
They won't.
they want.
Yeah, not with us. We don't offer all this crap. We offer level. We don't offer all this
I
crap.
got you.
But it's out there. That's what's in the buyer's guide. The buyer's guys gonna tell you, you
Got
get
it.
the increasing, you get the increasing, you can spin around, you can turn the cartwheel.
Okay.
You got all these type of turns. No, we believe in one kind.
Gotcha.
Level. Your premium stays the same. Your face amount stays the same. That make sense?
Whatever you agree to in the beginning.
Yeah, I don't want nobody guessing about their debt
I'm sure,
benefit.
like, how can I sign up for increasing?
Yeah, well, no, just buy as much as you need right now. You need $500,000, you want $1 million, all right? Ours, we got a feature like an increase in term, but it's not that. It's just we allow you to increase your face amount guaranteed by 10% every year. So your face amount will double over a 10-year period with us,
Gotcha.
right?
Right, cause that's what I got.
It's an increase in benefit rider, all right? But it's not an increase in term policies. You got a benefit to increase it to get closer to what you really wanted over time incrementally, so you can afford it.
They feel you still living, so.
Yeah,
you just- Right.
keep it increasing. Okay, pick up on traditional whole life.
Permanent life insurance is a general term used to refer to various forms of life insurance policies that build cash value and remain in effect for the entire life of the insured, as long as the premium is paid.
Highlight that. Because whole life means they whole life, or as long as the premium is what?
Hey,
Paid,
But she forgot to mention the parentheses.
or until age 100.
So that's when the whole life policy is up, typically at age 100. Right? Age 100. You turn 100 before you die, then the policy's over.
Right.
Wow.
Okay? Most people don't think that. Oh, it's for my whole life. No, it's till age 100. Whichever comes
Whole life.
first.
Okay. Wow.
That's why you say, oh, y'all got term. Well, my term end out at 95. Your whole life end out at age 100. Either way, whether you're 95 or 100, you're probably going to be dead. Like,
Most likely.
yeah, most likely. But our dead leaves you with $500,000 in savings. They dead leave you with 50. Which dead you want to be while you're alive? Dead alive with 500 or dead alive with 50?
50,
50,000 or 500,000?
500,000.
That's what the deal. That's the difference. Buy term, invest the difference. All right, keep going.
The most common type of permanent insurance is whole life. Whole life insurance provides lifetime protection and includes a saving element or cash value. Whole life policies endow is at the insured's age of 100, which
Endow means this. You took out a $10,000 policy. Endows at age 100 means when you turn 100, the amount of your premium, say let's say you're paying $60 a month. 40 paid for the insurance, 20 went into that savings. Right? You're paying for two things, even though they're going to give you one or the other. You're paying for two. So 20 of those dollars went into that savings, and based on the rate of return that they're giving you, 1 to 3%, by the time you reach age 100, that account will equal your face amount. So if you took out $10,000 worth of insurance and 20 been going to your savings at a 3% return, by the time you reach age 100, that savings account gonna equal to $10,000. So that means it endowed. Endowed simply means your savings account and your face amount equals the same. You took out a $10,000 life insurance policy, 20 of those dollars was going into that savings at a 3% return. By the time you reach age 100, that savings account gonna equal how much? 10 grand. And your face amount is how much? 10 grand. So when they both are the same amount, that means the policy endowed. So they're gonna get rid of your life insurance and send you your 10 grand.
10 grand, that's it.
That's how whole life works. At age 100, your face amount is gonna be equivalent to how much insurance you took out.
Right.
So at age 100, they're gonna hand you a check for your cash value, and you lose your insurance. When our term is up at age 95, we hand you a check too, but it's way more than 10 grand. Does that make sense? Because you bought term and invest the difference. You didn't bundle them both together where they say, okay, that 3% and paid off, baby. You done paid on this policy for 70 years. Here's 10 grand. although you paid me 80.
Right,
That's how it works. Make sense?
right.
So that's whole life. What age do it endow at?
100.
Age 100. What happens when you reach age 100?
It's over.
It's over.
They gonna give you your cash.
They gonna give you.
And and insurance policy is done. That's whole life. Any questions? Alright, flip over, alright? That's whole life. Go to, now inside of whole life, what we just explained was ordinary straight life. It works straight up like this. At age 100, they're gonna give you your cash. If you borrow from your cash, you deduct that from your what? Debt benefit. If you had 10 grand and borrowed 5, you die, what your family get? 5, because you borrowed 5. Does that make sense?
Right.
Gotcha.
Now go to limited pay. This is still whole life, but they saying it works, the policy works the same way. It's just how you want to pay for it. So ordinary straight life means you pay till you're age 100. Limited pay means I don't want to pay till I'm age 100. Let me pay it up in 20 years or 30 years like your mortgage. You can pick a 15-year mortgage or a 30-year mortgage. Based on how many years you chose to pay for it, that affects how much you're going to pay per month. Does that make sense? So if I want a limited pay policy and I want to pay it off in 20 or 30 years, then obviously I'm going to pay more per month. Does that make sense? And if I pay more per month, then my cash value and my policy is going to be paid off faster. But it still don't endow to age what?
100.
Age 100, because yeah, you paid it off faster, but you've been putting in more premium, so it lets the savings account grow at a faster rate. Does that make sense? But you still don't endow to age 100. You just paid it off in a limited time. I don't want to spread this payment out to age 100. I want to pay it off in 20 years. So if you hear somebody say I got a paid up policy, that's what they mean. They bought a limited pay.
So if they did pay it off early, could they get it early, or do they still have to wait till?
Get what? The cash value?
Yeah.
They can borrow it anytime they want to, but it ain't worth 10,000. It's only gonna be worth 10,000 at age.
100.
Right, because it still got they let it sit there, whatever they paid off, it may be 5 grand in there. And it takes another 60 years at that little interest they giving you to
Right.
equal 10,000. So can you take it before? Yeah, you can take whatever's in there, but it ain't gonna be 10 grand,
Right, okay.
right? Because it need time for the interest to compound, and they don't hardly give you no interest.
Right.
So it all works the same as a straight life policy. You just change the way you pay for it. I only want to pay it for a limited time. Great. The next one is a single premium. Whole life all works the same, but how you pay it varies. So if I want to pay it with a single premium, what does that mean? I want to pay it all up front.
Pay it up.
So you buy a $10,000 policy, they may say, okay, give me 7 grand. Great. You give them 7 grand. If you die, your family get 10. But when is the savings worth 10,000? At age?
100.
So what you
What
pay
difference,
7 grand?
what difference?
Some of the 7
You
grand
just paid
paid,
some
you
money.
just gave some money that you could have been using on something else. You just paid off a policy. You got bragging right. I paid it up, okay?
But you'd have been better off putting that in a savings
Oh,
account.
hello.
Somebody.
Yeah, pay them monthly, right? Your cash is better in your pocket. All right, let's go to adjustable life. So that's how whole life works. You got ain't 3 types of whole life policies. 3 ways to pay it. You can pay it. Ordinary straight life means you pay to age what?
What?
100. You can pay it limited pay. That means you pay to age, whichever you choose,
Yeah.
right? Or you pay single premium, means you paid it all up at one time. So next thing you go to is adjustable life. Go ahead and read for me adjustable life.
Adjustable life was developed in an effort to provide the policy owner with the best of both worlds, term and permanent coverage. An adjustable life policy can assume the form of either term insurance or permanent insurance. The insured typically determines how much coverage is needed and the affordable amount of premium.
So they saying adjustable policy means you can go back and forth. You can start out with it being whole life, move it over to term, take it from term, move it to whole life. You can increase your face amount, you can decrease your face amount. But if you increase your face amount, you got to tell them that you're still healthy. You got to answer medical questions. But depending on what your life is needing at that time, you can go inside this scale, inside this framework. You started with whole life because you just needed a burial plan. But then you started making babies. So you went inside your same policy, I don't want whole life no more, transfer this to term because I need more coverage. So you got to answer medical questions, but you switched your policy over to term because your situation changed. So that's an adjustable life policy, which means that you can adjust it.
You can do that.
Term allows you to get more coverage for a lesser dollar amount. Whole life give you a little bit of coverage for a lot of, but adjustable let you change it up based on your life situations. Does that make sense? So increase in term, what increases? What increases on the increase in term?
Face.
Face amount. What decreases on a decreasing term?
The
Base.
face.
How often do the price go up on annual renewable term?
Once a year?
Yeah, once a year.
How often does it go up on a level term?
Never.
Never. For the term, it stays the same. Does that make sense? All right. All right. Pick up on universal life. So we got term, we got whole life. How many types of whole life policies is it?
3.
No. One, but it's 3 ways to pay. It's only one that all works the same. It's one policy, it's just 3 ways you can pay it.
Gotcha.
Ordinary straight life, you pay it what? Till you age.
100.
Single premium, you pay.
100.
You pay for how long? Single premium.
Oh, single premium.
What does single
1
mean?
year?
You pay one time and it's
One
done.
time.
One
Right?
time.
One time. Limited pay, you choose. I want a 10-year, I want a 20-year, or I want a limited pay to age 65. You choose. But it don't mature until age.
100.
And mature means endow. And endow means that's when the face amount equals the what?
The premium.
The cash value.
Cash value.
That's it. All right. So now we're gonna go on universal life and universal life and variable life and those last type of policies.
Universal life insurance is also known by the generic name of flexible premium adjustable life. That implies that the policy owner has the flexibility to increase the amount of premium paid into the policy and to later decrease it again. In fact, the policy owner may even skip paying a premium and the policy will not lapse as long as there is sufficient cash value at the time to cover the monthly deductions for the cost of insurance.
So what they're saying is that you got a universal life policy. You can change how much you want to pay. You can pay more. You can pay less. You can not pay it at all, because universal life builds up this cash value savings, right? And if you ain't got the money, you don't want to pay it this month. Guess what they do? Borrow the money out of your savings to pay your policy. Does that make sense? So it's universal life. You can get universal life is an annual renewable term policy with a savings account attached to it. That's all it is. If you pay the minimum premium on that, right? You pay the minimum premium. All you got is an annual renewable term. So every year, what's gonna happen to your price? It's gonna go up, right? If you pay the target premium means you're paying enough to put the insurance in place and to accumulate a savings. And if you're paying the target premium, as that savings build up, you can decide some months that you don't want to pay it at all. What would they do?
Transfer it over.
They're gonna take the money out of your savings and pay it that way, and now your policy stays in force. But every year on your universal life policy, know this, that your price of insurance or your cost of insurance does what? Goes up, because the insurance portion of that policy is annual renewable term. Is it a term policy? No. It's a whole life policy. It's a permanent policy. But it's built with 2 components, an annual renewable term with a savings account. So that's called a cash value policy. Endows at age 100. Does that make sense? But at some point, your cost of insurance is going up. Every what? Year. And some people, they never see a bill. The price is going up every year. They never see a bill because they're taking the difference out of the savings. And if the savings run out, guess what happens to the policy? It cancels.
What?
So some people sitting around with universal life policies, they're excited because they got $200,000 and they're only paying $15, $20 a month. But what they don't understand is the price is going up and they don't see it. And all of a sudden now they got no more cash in the savings. And the life insurance company gonna say, hey, you owe us $200 a month now because ain't no more cash left, so you got to pay $200 a month now. What you think the people gonna do?
Drop it.
And what you think the insurance company care? Nothing. They make pure profit for 30 years off of you. They ain't gonna never have to pay no debt claim. See you later, sucker. That's how it works. So we gotta understand that. If you pay the minimum premium, you only paying for an insurance component at all. Only. If you pay the target premium, you paying for insurance and savings. So it gives you the ability to skip a premium if you want to, because all they're gonna do is take it out of the.
Savings.
And when the savings is depleted,
You're gonna be taxed, so there's no sense in doing that.
yeah, first in, first out rule. So then over here you see that they got a quarter that say you can choose on universal life, you can choose death benefits option A, option B. Death benefit option A just means if you die, your family simply just get the death benefit. You die, they're gonna get, if you took out $100,000 universal life policy, you got option A, when you die, they're gonna get $100,000. Option B means they're gonna get both. B means both. They get your face amount and they get whatever savings that you built up. Whatever's left. If you chose option B. Does that make sense? Why would people choose option A then? It's cheaper. Make sense?
Right.
That's it on universal life policies. How often does the policy premium go up? Every year. Would they necessarily see it?
No.
No.
Because they're gonna take it out of the,
Savings.
and when the savings is gone,
They're gonna take it from them.
They're gonna take it from them. If they don't pay it,
It's
They
both.
out.
you can pay the minimum premium. If you pay the minimum premium, all you got is a what? Annual renewable term policy. To get the savings going, then you gotta pay what premium? Target. A target just means they're targeting the savings goal. That's all a target premium. I'm targeting some savings. Does that make sense? And what the savings is used for? Offset the increase in your insurance. And when that balance hits zero, you're in trouble. Does that make sense? All right, so let's go to variable whole life. Whenever you hear the word variable means it variates like this, up and down, stock market. It's tied to the market. So it ain't like a regular whole life where they give you the savings, they give you this guaranteed 1, 2, 3%. Variable means no, whatever the stock market do, that's what your savings gonna do. So the biggest difference between a regular whole life policy and a variable whole life is the savings component is tied to the what? Stock market. It variates. So there's nothing guaranteed about it.
The stock market determines what the policy
Well,
is.
it's gonna be worth, right? Now, the benefit to it is that when they die, their family gonna get the insurance and savings on a variable whole life. Regular whole life, the insurance company keeping the savings. A variable whole life, the company, the family get the insurance and they get the savings. But the savings can be $100,000 today, and the market can drop and it'll be nothing tomorrow.
Right.
So the death benefit is guaranteed, but it's not fixed. Cause today you can have $10,000 in insurance and 50 in the savings, and you die, your family will get 60,000. It's guaranteed, but it's not fixed. Cause tomorrow you can lose all your savings, and y'all getting this 10,000.
Stock market crash.
Yeah,
And you put all your money in there, and you can lose it all. That's a variable.
and it's gonna crash.
Yeah, it's a variable whole life. Now you can get a variable universal life. Works the same way. You don't got to choose option A or option B. You get both anyway. But it's tied to the stock market. Nothing is guaranteed.
Risk.
That's how it is. Last type of policy is a combination plan. Combination plan means you got joint life, right? You're gonna have joint life, and joint life means that two people get on one policy, but they only pay one premium. So joint life, me and my wife got one policy. They ain't charging us for each one of us. They only charging us for one of us. And it's gonna pay the death benefit out on the first person that dies. So if I die, my wife gonna get the $1 million. When she die, ain't no policy left, because we only paid for one person. Right? We can afford to pay $80 a month, we can afford to pay 40. So it's about a joint life policy. First person that died, the second person get paid, then they got to pick up another policy. Does that make sense?
Yeah.
So those are called combination plans. The second one is called a survivor life. Survivor life means when the first person died, don't nobody get nothing. When the second person died, the kids get the money. So it pays on the second person to die. Well, you don't know who's gonna die first.
Right.
You never know. Right? So for me and my wife, that will work. If we can afford to get pay premium on both of us, that will absolutely work for us, because if I die, Primerica business is still moving. Our beauty salons are still moving. So our income doesn't necessarily change when I die. But when she died, it does, because neither one of us here to run the salons or Primerica. The kids don't know how to do it. So the kids get the big policy. It pays on the second to die, but you're only paying premium for one person. And it's cheaper when you buy it on survivor life, because they ain't got to pay no debt claim quick. First person gonna be dead, and they still ain't got to pay no debt claim. So survivor life premiums are lower, because the insurance company ain't got to pay out until the second person is dead. Joint life is higher because they got to pay out on the first person to die. So what they do is they use a combined average age. So if I'm 43 and my wife 41, they charge us for a 42-year-old person,
Okay.
right?
You said
Combination.
Your wife 40 or you 40 and the other
No.
one 41?
Yeah, if I'm 43 and my wife 41, they're gonna
got
charge
you,
us
I
at
got
age
you.
42.
I got you.
Or my wife's 60 and I'm 55, they're gonna charge me for 42 and a half. Or whatever, you know what I'm saying? They're gonna average age.
I got you.
You don't pay for one person.
So would you advise getting it?
No, if you can afford it, and if you can't afford it, I mean, if I couldn't afford to pay for a life insurance for me and my wife, I just couldn't afford to, I'll buy a survivor life policy. Would I ever recommend it to a client? No, we don't even sell stuff like this primarily. Like, no, you may need a little bit less coverage, but, you know, see, me and my wife kind of like in a perfect world scenario for really a survivor life policy, because we business owners.
Right.
If I die today, we got agents. Y'all still gonna sell insurance. We gonna be dead. Y'all still gonna sell. So her income still gonna be there, cause y'all still trying to build y'all business, and y'all building y'all business keep mine going. If I die, you ain't gonna stop wanting to do what this thing gonna do for you and your family. So it keeps my wife paid. At the salon, if I die or she die, people still rent booths because they want to cut her and make their money.
Right.
So it doesn't matter when my wife die, money stays the same. When I die, money stays the same. But when we both die, kids don't know how to run these operations.
Right.
So they need the money on the second to die.
Okay.
We save
Gotcha.
premium because we
Gotcha.
only have to pay on one person.
Got it.
Does that make sense? And if it's survival life, it's cheaper because they only got to pay on the second to die. Joint life is more because they got to pay as soon as the first person died. But joint life is still cheaper than you getting one on me and her. Make sense? It's covering both of us because they don't know who's gonna die when, but we only paying premium on one based on a what? Average age of the two. That makes sense? Joint life, survival life, those are combination policies. Joint life pays on what? The who?
The first,
Survival life pays on the,
second,
which one pays the cheapest premium?
second,
So
survival.
survival life, right? What do they use to determine the age?
The two ages combined.
Right. If I get a universal life policy, how often do my premium go up?
Every year.
Where do they get it from?
Savings.
When the savings is gone, what happens?
They
You
come to
pay.
you.
If I don't wanna pay my premium on the universal, where they take it from?
It's gone.
If I don't wanna pay the premium, it's gone, right? But if I got savings and before that happened, before the money's gone, what do they do if I don't wanna pay my premium?
Take on savings.
And the only way the savings gonna be available, I pick what kind of premium? Targeted premium,
Targeted.
right?
Okay.
How many ways can you pay a whole life policy?
2 ways?
3 ways.
3 ways.
You can pay it straight life, which means you pay to age,
100.
100. You can pay a single premium, which means you pay single premium, single,
Upfront.
one up front, right? Or you pay a limited pay
And for a certain amount of time.
for a certain amount of time, right? If I get a decrease in term, what decreases?
The face.
Face.
If I get an increase in term, what increases?
The face.
What happens to the premium?
Stays the same.
Stays the same for that term. If I get an annual renewable term,
It
Every
goes
year.
up.
it goes up every year. But do you gotta prove that you're healthy?
Yeah.
No, guaranteed insurability. Yeah, we gotta prove. Now, that's no messing question. You just gotta pay the difference and the price. Does that make sense?
Yes.
Contract of adhesion.
Right, cause you see it, cause they want.
Take it or leave it.
Contract of adhesion is take it or leave it. Unilateral.
Is a true statement.
Unilateral contract.
Equal.
Opposites. I mean,
One person has the balance of the responsibilities or the commitment.
The insured,
The insure,
Uninsured.
the insurer.
insurer.
Yeah, we gotta do what we gotta do. Does that make sense? All right, last thing, guys, we're gonna let you go. It's annuity. So annuity is an upside down life insurance policy. That's all annuity is. It's a life insurance product, but it's upside down. The life insurance, you pay premium in case you die. Annuity, you pay premium in case you live.
Yeah.
Right? One day I'm gonna get age 65. I need some money so I can start living off of it when I can't work for it no more. So I'm putting money in my annuity every single month. That's called the accumulation period. I'm putting money in it so I can accumulate money. It's called my accumulation period. But at some point, page 37, very top says accumulation period. But then I have a second time, it's called the annuity period. Annuity period is when I ain't putting no money in. I want to take it out because I got to live off of it. So you got the accumulation period. That's when you put money in, you accumulate money. Annuitization period, when I need the money now to take care of me. So I'm ready to pull the money out. So all annuity is you saving money for a future event. At some point, my kid's gonna go to college. I put up enough money to have it. At some point, I want to retire. I put up enough money to have it. Does that make sense? So an annuity just position yourself to have money that you cannot outlive.
Right.
Does that make sense? Now, who's the annuitant? Annuitant got to be the person whose life being covered, like the insured. I may be the annuitant, but that don't necessarily mean I'm the policy owner. See, I can take out annuity on my wife. She's the annuitant. I'm the policy owner. So what the insurance company do is they consider their life expectancy just like they do with life insurance. If you're 77 years old, most life insurance is going to cost you a whole lot of money. Because they say you're going to what? Die. An annuity, if you're saying I want to never outlive my money, right? The annuity saying you're going to live long. The life insurance said you're going to die quick. So you can be 77 and take out an annuity, and the annuity company saying, man, shoot, man, we're going to have to pay you this, and even if you ran out of money, we still got to keep paying you this certain amount. So we got to act like you're going to live longer than we think you're really going to live. So we're going to say you're going to live to see 120. The life insurance mortality say you're going to live to see 90 because they want to charge you more because you're going to die. The annuity say we're going to have to keep paying out, and you might be still alive. So my